For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Today, shares are trading at approximately $16. Much like many other companies that entered the public market through special purpose acquisition firms, SoFi struggled to meet the high expectations set before its merger. Rising interest rates compounded these issues, further weighing down its valuation and leading to a disappointing 3-year return for investors. Despite these challenges, there are signs of resilience and hope. Many Wall Street analysts remain optimistic about SoFi's future, even in the face of its historical performance. Out of the 19 analysts currently tracking the stock, only 3 have rated it as a sell. Interestingly, the stock has already surpassed the average price target of $11.66, though it still lags behind the highest target of $20. This leaves investors with a critical question. Is SoFi worth considering at its current valuation, and does it have the potential to reach the more optimistic estimates projected by bullish analysts? Let's dive into the company's history and evolution to better understand its potential. Over time, the company broadened its range of financial services, venturing into areas such as mortgages, auto loans, personal loans, credit cards, insurance, estate planning, and even tools for stock market investments. In 2022, SoFi achieved a significant milestone by securing a United States bank charter, which allowed it to launch its digital-only bank. Unlike brick-and-mortar financial institutions, SoFi operates entirely online, enabling it to scale its operations more rapidly and cost-effectively. The absence of physical branches also allows SoFi to streamline its processes, gather customer data more efficiently, and deploy artificial intelligence to enhance its financial services. In the long run, SoFi aims to become an all-in-one financial platform, eliminating the need for customers to juggle multiple apps for their banking, investment, and financial planning needs. The company's growth metrics tell an impressive story. Its membership base expanded from 2.52 million at the close of 2020 to 9.37 million by the end of the third quarter of 2024. Similarly, the number of products offered surged from 1.85 million to 13.65 million during the same time frame. SoFi's financial performance has been equally noteworthy. Between 2020 and 2023, its adjusted revenue grew at a compound annual growth rate of 49%, increasing from $621 million to $2.07 billion. The company achieved a significant milestone in 2021 when it posted positive adjusted earnings before interest, taxes, depreciation, and amortization of $30 million. This figure grew at a remarkable compound annual growth rate of 279%, reaching $432 million by 2023. This achievement puts it on track to deliver a full-year profit for 2024, a critical milestone that signals the company's operational efficiency and financial health. However, this trajectory of growth has not been without its missteps. During its pre-merger presentation, SoFi set ambitious targets that it ultimately could not meet. The company initially forecasted $2.11 billion in adjusted net revenue for 2023. However, it fell short of these projections due to 2 primary headwinds. First, rising interest rates made its loan offerings less attractive, as higher rates increased the cost of borrowing. Second, its student loan segment faced prolonged challenges due to a nearly 4-year federal freeze on student loan repayments, which lasted from March 2020 to September 2023. During this period, eligible borrowers were allowed to pause their loan payments, with interest rates set at 0%. Fortunately, these challenges are now beginning to recede. The Federal Reserve reduced interest rates 3 times in 2024 and anticipates at least 2 additional cuts in 2025. Meanwhile, the expiration of the federal freeze on student loans is providing a much-needed boost to SoFi's student loan business. Beyond overcoming these obstacles, SoFi has also been focused on expanding its ecosystem. In 2020, the company acquired Galileo, a fintech platform that provides essential services such as payment processing and card issuance to over 100 companies in 16 countries. Galileo now manages more than 160 million accounts and contributed 10% of SoFi's profit in 2023. This acquisition has proven to be a strategic move, solidifying SoFi's position as a key player in the fintech space. In October 2024, SoFi took another bold step to strengthen its business model. It finalized a $2 billion agreement with Fortress Investment Group to underwrite its loans and transfer them to other lenders. This arrangement allows SoFi to generate additional fee-based revenue without significantly increasing its debt burden, demonstrating the company's commitment to sustainable growth. Looking ahead, SoFi has set ambitious yet achievable goals goals for 2024. It expects its adjusted revenue to grow by 22 to 23% between 2023 and 2026. Analysts predict that SoFi's revenue will grow at a compound annual growth rate of 19%. Furthermore, earnings per share on a generally accepted accounting principles basis are expected to grow at a compound annual growth rate of 90% during the same period. But the company's stock is not without its risks. It currently trades at a higher valuation compared to its more established competitors. For instance, SoFi's price-to-book ratio stands at 2.8, significantly higher than Bank of America's ratio of 1.3 and Wells Fargo's ratio of 1.5. SoFi's growth prospects may justify its premium valuation. At $16 per share, the company's enterprise value is approximately $16.2 billion. These metrics suggest that SoFi's current price offers a reasonable entry point for investors who believe in its long-term potential. In conclusion, SoFi Technologies has experienced its fair share of challenges, but continues to demonstrate resilience and innovation. Its digital-first approach, expanding ecosystem, and focus on sustainable growth to make it a compelling choice for investors seeking exposure to the fintech sector. However, as with any investment, it's crucial to weigh the risks against the rewards. With that being said, I will see you in the next video.